All right, so this is day 9 of my stock market portfolio, my journey to $500,000. All right, so you can see that my margin account, the equity in my margin account increased back to 5,900. So better than day 8, of course, but still much lower than what it used to be. So if I add up the equity, total equity in my Questrade account, got 5,942 plus whatever I have in my TFSA, which is 39,849. And whatever I have in my RSP, 17,535. So that's 63,326. So finally, went back, back in the 60s. All right, so what did I do on Friday? So in my margin account, first of all, I rolled over my Nvidia call option. So I had a call option that expired August 16. I rolled it over to the following week, collected about $205, which gives me a return of per week. So 205 divided by 15,500. So it gives me a return of about 1.3% in 1 week. Annualized, 68%. Now I had the choice to sell, of course, September 20th expiry date, but I think I was collecting about 3% for the 5 weeks. So I felt like 1.3% in 1 week is better than 3% in 5 weeks. I also had to roll over my Netflix credit spreads because I had a put credit spread at 310, and of course Netflix was trading at 303, so I had to roll it over or else I confirm max loss. So what I did is I purchased back the call option at, I think it was trading almost at $500 basically, but I sold the August 23rd, so for the following week I sold the 310, and I also sold the call option at 315. So basically by Friday I need Netflix to trade between 310 and 315. Now of course, if by Wednesday it's trading at 310, I'm going to close out the trade. I'm not going to wait till Friday. And then I also sold I also adjusted the credit spread that I had at 320 on Netflix. But so this one, I give it a bit more time. I went all the way out to September 6th, and I need Netflix to trade between 320 and 325 by September 6th. Now, of course, if between now and September 6th, if Netflix is trading close to 320, I'll probably just close out the trade early. I'm not necessarily going to wait till September 6th because these adjustments are just made to avoid maximum loss. I'm already not expecting to make a profit from these trades. So that's the problem I have with credit spreads. The concept to me makes a lot of sense, but for some reason, whenever I place a trade and I pick a certain range, for some reason the price always goes outside the chosen range. So I end up making too many adjustments and then it ends up being a losing trade. So even though I think the concept is great and it's something that I want to get better at, it hasn't been working too well for me, but I'm going to continue with it because I truly believe that it's the right idea. For example, should I place 30-day trades or should I place 60 trades with the intention of closing the trade early? Should I give myself a tighter range to collect a higher premium, or should I go very wide and collect a smaller premium but risk more in case the stock goes outside that range? Although the probabilities of going outside the range is smaller, but if it does happen, then I lose a bigger amount. While if I take a smaller range, I collect a higher premium, even if the probability is smaller to win. Worst case scenario, if I lose, I won't be losing that much. So I don't know exactly which approach to take with credit spreads, but I know they do work and I'm still figuring it out. I've got these credit spreads on the SPY. These ones should be fine. If the market rallies back, they should be fine. I've got Tesla that expires August 30th, and basically I just needed to stay below 260 and above 205. And I think on Friday it closed at 219. So as you can see, most of my call options expired, so I have a lot of positions here that only show the stock, not the options. So by next week I'll try to sell call options against them if the premiums are high enough. Now, if the premiums are not high enough, I'll have to wait a bit until the stock goes up. In my TFSA, I closed the unit trade that I had. I made about 5% in a month. So this one was closed out. It wasn't a big amount. I think it was a profit of $80. So if we look at my positions in my margin account, the ones with the biggest loss, United States Steel, Kraft Heinz, and Box, but mostly United States Steel, 2,800 lost. But I do have a book value of 7,300, so I did put a lot in it. This stock, I actually got the idea from Jeremy from Financial Education. Last time I ever take tips from him. But in all honesty though, I bought this stock because I bought this stock because the premiums were so high, the option premiums were so high, but also because the PE ratio was very low. But yeah, so now I'm stuck with a $2,800 loss on United States Steel, but I didn't sell the stock yet. In my TFSA, biggest loser is Teva Pharmaceuticals at a $3,000 loss. And in my RSP, my biggest loser is Novavax at a $5,000 loss. Although it sort of rallied this week when everything else was dropping, Novavax went up 40%, I think, one day, and then 10% the other, and another 10% the other day. But overall, I'm still down 80%. Overall, I'm still down 80% on the stock. So here's a trade I was thinking of doing next week. Selling a put credit spread on the Qs. So this is an ETF that tracks the NASDAQ. So I was thinking of going either, so see, that's the thing. Do I go 30 days out or 60 days out? Let's do 60 days out. All right, so I would go with a 15% probability of losing on this trade. So I'm going to pick a delta here on the short strike. Leg 2 is the selling strike. So I'm going to pick a delta of 0.15. So I'll try 171. No, that gives me 13. Let's try 172. All right, so 172 gives me a 15 delta. And then I'll buy the 167. So that's a 5-point difference between both strikes. So my max loss is $500. So this option here that I'm buying is for protection. So I'm selling the 172 put, but I'm buying the 167 put for protection, expiring October 18. So 61 days out. I have a 15% chance of being wrong, so an 85% chance of being right. So we're after hours, so I don't know if these numbers are accurate, but these were the last traded amounts. So 258 and 181, so a difference of about $80. So with this trade, I could collect $80 as long as by October 18, the Qs stay above 172. Based on this delta here, there's an 85% chance of that happening. But without even looking at the deltas, if you just look at the general market, if the market rallies back up, then it has a very good chance of being above 172 come October 18. And in fact, I don't have to wait till October 18. I could just close it when after 2 or 3 weeks, the ETF starts going back up, then I could close my trade early for $50 or $40. So I sold it for 80, I bought it back for 40. There's two things that can make this trade profitable. Either the stock goes back up or the stock stays as is, but days go by. So now that's the other thing. Now, what do I do if the trade goes against me? What if I place this trade, collect my $80, and when I do it, the ETF is trading at 185. What if it starts going down to 184, 183, 182? The premium that I sold for $80 will be worth more. So now if I have to buy it back, I'll buy it back for more. So it'll be for a loss. So what's the general strategy for that? Some say that when the stock goes against you and it gets closer to your short strike, the right thing to do is to never touch the short strike, never buy it back, only sell the opposing credit spread. So if I'm selling the put credit spread here and the stock goes down, then I can sell the call spread to collect the premium. So that way I reduce my maximum loss. And since I have 60 days, well, I have time for the stock to come back up. But now if I do that, if I sell a call option, let's say at 185 because the stock dropped to 178, what if it goes back up and now I just created myself a restriction on the call side, a restriction that I didn't have before? So there's so many things to consider. Do you make adjustments early? Do you not make adjustments at all? Do you just actually close the trade at a certain point, move on and place another trade? So let's say the 80 cents becomes $1.60. Do I just buy it back at $1.60, accept my 80-cent loss, and just move on, sell another one a little bit lower, and the profits of the new one hopefully compensate for the loss that was generated in the first one? So there's different approaches. I'm still not sure which one works best in the long term. But this is a trade I'm definitely going to place on Monday. So, all right, so this was a quick overview of my portfolio day 9 and the trades I placed on Friday. So if you have any questions, leave them in the comment section below. Any suggestions as well, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Also check out the other referral links below. Thanks for watching.